The single, decisive skill that elevated 19th century speculators from mere gamblers to enduring financial titans was not luck, superior access, or prophetic insight. It was the rigorous, almost obsessive mastery of systematic market observation, a discipline known historically as tape reading. The markets between 1850 and 1900 were a chaotic crucible, defined by extreme volatility, frequent gut-wrenching panics, and a pervasive lack of regulatory oversight that is unimaginable today. This environment demanded an edge far sharper than anything based on fleeting rumor or emotional reaction to newspaper headlines. Success in this savage landscape depended entirely on a deep, foundational cognitive skill that could translate raw market action into actionable intelligence. The late 19th century exchanges were characterized by dramatic price swings, often triggered by geopolitical events, crop failures, or the sudden failure of a major bank. Information traveled slowly, often arriving hours late to peripheral trading centers, making reliable fundamental reporting virtually useless for short-term speculation. Without the instantaneous centralized data feeds and sophisticated algorithmic tools that define modern trading, the professional trader had to become their own real-time data processor and analyst. This necessity established a critical challenge: how to derive truth from the noise when the only reliable source was the sequence of transactions themselves. The vast majority of speculators during this era failed quickly and spectacularly, usually operating on the basis of tips whispered in hotel lobbies or emotional responses to the sensationalized headlines printed in the morning papers. These amateurs chased movement, reacted to fear, and fundamentally misunderstood the underlying forces driving prices. They sought shortcuts and relied on external validation, ensuring their capital was constantly vulnerable to the manipulative forces inherent in unregulated markets. The professional, however, developed an internal mechanism for truth verification, relying exclusively on the transactional evidence provided directly by the exchange floor. Before we delve deeper into the mechanics of this lost art and how it applies to today's high-speed markets, please take a moment to subscribe and leave a quick comment below. Even just a single word helps the algorithm recommend this video to more people and shows me that this kind of analytical content truly matters and is worth creating. We understand that trading can become difficult and confidence may waver during challenging times, so please remember to return to this channel when you need a grounding perspective on market mechanics. Your support ensures the continuation of this deep dive into the historical strategies that still define success. The separating factor between the fleeting speculator and the enduring professional was therefore the ability to process and interpret raw transactional data systematically. This skill transcended mere chart plotting or basic arithmetic. It was an applied form of market statistics performed in real time. We are talking about the core skill of mastery of systematic market observation, which became universally recognized under the name tape reading as the technology evolved. This discipline required relentless focus and an absolute commitment to letting the market data, and only the market data, dictate action. The foundation of this systematic observation was a simple yet revolutionary piece of technology: the stock ticker. Invented and patented by Edward Callahan in 1867 and later popularized by Thomas Edison's improvements, the ticker machine quickly spread across brokerage offices in major financial centers. This device printed a continuous physical strip of paper, the tape, that recorded every transaction executed on the exchange floor in sequence. The tape was the precursor to all modern data feeds, providing the only real-time window into the market's internal workings. The data streaming from the ticker was sparse but absolutely crucial, distilling the market action down to three fundamental components. First, it provided the price at which the transaction occurred, establishing the immediate valuation of the asset. Second, it indicated the volume of the trade, often represented by abbreviations or implied by the size of the block, revealing the intensity of supply or demand. Most importantly, the tape provided the chronological sequence of these events, establishing the time and order in which these fundamental forces interacted. For the professional trader, the tape was not merely a record. It was a living narrative that had to be meticulously transcribed and analyzed. The best traders rarely relied solely on the fleeting visual image of the tape scrolling past. They employed dedicated clerks or maintained rigorous personal records in massive ledger books. This necessity for manual record-keeping was driven by the need to aggregate and organize the raw data into a meaningful structure. The physical act of writing down the transactions forced a level of cognitive engagement and pattern recognition that passive observation simply could not achieve. The true genius of the professional lay in their method of calculating the ongoing balance of supply and demand, moving far beyond simply noting the last price. They tracked the accumulation of volume at specific price points, meticulously noting whether large blocks were being absorbed by buyers or distributed by sellers. This detailed accounting allowed them to determine if the prevailing market movement was due to genuine institutional positioning or merely noise created by temporary speculative frenzy. The critical difference was that professionals focused intensely on the relationship between price movement and volume signature, whereas amateurs only saw the arbitrary closing price or the headline change. Interpreting this complex sequential data was often referred to as understanding the language of the tape. This language spoke in terms of pressure, liquidity, and exhaustion, providing clues invisible to the casual observer. The core principle guiding 19th century speculation was identifying the line of least resistance, which determined the direction where the path of future price movement requires the least effort. If supply had been thoroughly exhausted at a lower level, the path of least resistance was clearly upward, requiring minimal buying pressure to initiate a significant markup. Conversely, if demand dried up and volume accumulated heavily without upward progress, the market was primed for a decline. Tape reading taught the systematic recognition of the three fundamental stages of market movement, a cyclical pattern that repeats across all time frames and asset classes. The first stage was accumulation, characterized by heavy volume occurring within a narrow price range, indicating professional buying absorbing supply without alarming the general public. This period of quiet absorption was followed by the markup phase, where the price rapidly advances as the supply has been cleared and the line of least resistance is established. Finally, the cycle concluded with distribution, where the professionals sell their accumulated shares into rising prices and high public enthusiasm. The professional trader developed an almost intuitive ability to identify these phases purely through the subtle interplay of price and volume signatures on the tape. They understood that the market rarely moved instantly from one phase to the next, but rather transitioned through periods of testing and confirmation. For example, a successful accumulation phase would often be followed by a sharp, low-volume dip designed to shake out weak holders before the genuine markup began. Recognizing these maneuvers required constant, disciplined attention to the specific data points provided by the continuous stream of transactions. The systematic recording of volume blocks against specific price levels was the only way to confirm whether selling pressure was persistent or merely transient profit-taking. This meticulous approach allowed the professionals to anticipate major moves, rather than simply reacting to them after they had occurred. The amateur, looking only at the dramatic price change, would jump in late during the markup phase, often becoming the ultimate buyer during the distribution stage. The tape reader, however, understood that the most profitable trades were initiated during the quiet, high-volume periods of accumulation or distribution, long before the public became aware of the shifting balance of power. This focus on the internal mechanics provided the necessary edge to survive and thrive in a volatile, often hostile market environment. The discipline required to maintain this systematic observation was immense, demanding hours of focused attention every single day. Traders who mastered the tape became adept at filtering out the emotional noise of the trading floor, treating the data stream with the cold, objective detachment of a statistician. They understood that the tape never lied, even when the news headlines were wildly misleading or manipulated by interested parties. This reliance on verifiable transactional evidence rather than anecdotal input was the hallmark of the successful 19th century operator. The ability to calculate and project supply and demand dynamics based solely on the raw ticker data was the specific separating skill that created fortunes. The systematic recording process involved creating a running tally of trades, often categorized by size, to distinguish between the actions of large operators and the noise of small speculators. If a stock traded 500 shares at 95, followed by 1,000 shares at 95 and 1/8, and then another 2,000 shares back at 95, the tape reader immediately saw high volume absorption at the 95 level. This suggested that large buyers were deliberately preventing the price from dropping further, indicating a strong support zone and potential accumulation. Conversely, if the price moved up quickly on small volume and then stalled, followed by heavy selling, it signaled distribution into rising prices. The interpretation extended beyond just the price levels. It involved reading the texture of the tape itself. A thin tape, characterized by low volume and infrequent trades, suggested general market indifference or professional dormancy. A thick tape, showing rapid-fire transactions and heavy volume, indicated a critical period of conflict between supply and demand, often preceding a major move. The successful trader learned to differentiate between the heavy, persistent volume of institutional accumulation and the frantic, disorganized volume of public panic. The cognitive challenge was translating the sequential, linear data of the tape into a three-dimensional understanding of market depth and pressure. They had to mentally map where the large orders were being placed and executed, essentially reconstructing the order book using only the executed trades printed on the paper strip. This required extraordinary mental discipline and the development of specialized shorthand and notation systems to keep pace with the market's action. Without this systematic processing, the tape was just a meaningless stream of numbers. With it, it became a detailed map of institutional intent. One of the most powerful applications of tape reading in the 19th century was its utility in detecting and navigating market manipulation, which was endemic and completely legal. During this period, markets were heavily influenced by pools, which were organized syndicates of wealthy operators who combined their capital to deliberately accumulate or distribute massive positions in a stock. These pools operated over weeks or months, and their success depended entirely on their ability to move the price in their favor without prematurely alerting the general public. The tape was the only tool capable of spotting these operations early. Pool operations required time to execute their plans, meaning they had to engage in large-scale buying, accumulation, or selling, distribution, over extended periods without causing dramatic price movements that would raise alarms. The best traders used systematic tape reading to spot the telltale signs of these activities, often weeks before the pool's intentions became obvious to the wider market. By tracking volume meticulously, they could identify periods where intense, high-volume activity occurred without a corresponding significant change in price. This specific pattern, high volume, narrow range, was the definitive indicator of absorption. If a stock traded 10,000 shares within a 1/8 point range over an hour, the professional knew that someone large was either buying everything offered, accumulation, or selling into every bid, distribution. The amateur saw stagnation. The tape reader saw a massive transfer of ownership. This early detection provided the professional with the necessary lead time to position themselves either alongside the pool or against its eventual move. Another critical element of systematic observation involved the use of time and sequence as a fundamental metric for assessing market health and momentum. It was not just what traded, but how fast it traded that provided crucial clues. Rapid fire volume occurring at the high end of a move often indicated panic buying by the public or the frantic closing of short positions, signaling a climax. Conversely, slow, steady volume within a tight range suggested calculated professional positioning, indicating patience and strategic intent. The speed of the tape, therefore, acted as a measure of market hysteria versus institutional control. A sudden acceleration of transactions, especially if accompanied by volatile price swings, was a warning sign of instability and often marked the end of a trend. The professional trader learned to recognize the distinct volume signature of a selling climax or buying climax, purely through the intensity and sequencing of the printed trades. A selling climax, for instance, would show a massive burst of volume as panicked sellers dumped their holdings, followed immediately by an abrupt slowing of the tape, indicating that the supply had been completely absorbed by waiting professional buyers. The masters of the tape emphasized the necessity of absolute emotional detachment from the market's movements. They preached that the trader must act as a statistician, focusing exclusively on the cold, hard numbers printed on the paper strip, ignoring all external noise, rumors, and personal biases. News headlines were considered secondary, often manipulated instruments designed to distract or mislead the emotional trader. The only truth was the transactional record, which objectively displayed the current balance of supply and demand. This discipline fostered a core principle: the necessity of waiting for confirmation before committing capital. The tape reader did not guess. They waited for the market itself to confirm the direction through specific volume signatures and price reactions. For example, before initiating a long position following a period of accumulation, the professional required the price to move above the accumulation range on increasing volume, confirming that the line of least resistance had indeed shifted upward. This systematic approach eliminated impulsive trading and ensured that risk was only taken when the internal market mechanics supported the decision. The discipline extended to understanding the concept of effort versus result. If the market exerted massive volume, effort, but achieved little price movement, result, the professionals knew that a major conflict was underway, indicating either strong resistance or strong support. If, however, a small amount of volume, effort, resulted in a significant price change, result, it indicated a clear path forward, confirming that the opposing force had been exhausted. This ratio, derived purely from systematic observation of the tape, was the analytical cornerstone of their decision-making process. The 19th century masters understood that the market's true intentions were revealed not by the magnitude of the price change alone, but by the volume required to achieve that change. They meticulously recorded the opening and closing ranges of specific stocks, noting where the heaviest volume occurred relative to those boundaries. If a stock consistently closed strong near its high, even after periods of intraday selling pressure, the tape indicated accumulation and strength. If it consistently closed weak, despite attempts by buyers to lift the price, the tape signaled underlying weakness in distribution. This detailed, systematic tracking provided a deep, non-emotional understanding of the market's underlying health. The ability to read these subtle shifts required a level of focus that few amateurs possessed. Furthermore, the professional trader learned to identify false moves designed specifically to trick the untrained eye. These might include a sudden, sharp price spike on low volume, intended to attract amateur buyers, or a quick dip designed to shake out nervous holders. By comparing these movements to the concurrent volume signature on the tape, the disciplined operator could immediately discern whether the move represented genuine institutional intent or merely transient noise. This systematic filtering mechanism was their primary defense against the rampant manipulation of the time. The legacy of these methods is profound, demonstrating that even without modern computing power, meticulous data analysis provides the ultimate trading edge. The separation between the masters and the masses was fundamentally an issue of intellectual rigor and procedural discipline. The masters treated trading as a scientific endeavor, applying statistical methods to raw data, while the masses treated it as a game of chance influenced by emotion. This commitment to systematic observation was the key that unlocked consistent profitability in the most chaotic markets in history. The seemingly archaic practice of 19th century tape reading did not disappear. It merely evolved, forming the direct intellectual lineage for modern technical analysis and specialized trading methodologies. The painstaking manual observation of transactional flow laid the groundwork for formalized systems that are still taught and utilized today. The most notable example is the Wyckoff method, which explicitly formalized the concepts of accumulation, distribution, and the law of effort versus result, all of which were derived directly from decades of manual observation of the physical ticker tape. As markets grew larger and the speed of transactions increased, the physical limitations of manually recording every trade became obvious, necessitating a shift in analytical tools. Charts, which plot price and volume over time, emerged as necessary shortcuts, allowing traders to quickly visualize patterns that previously required hours of ledger entry. However, these charts were not new ideas. They were simply graphic representations built entirely upon the foundational principles established by the tape readers. The chart is merely a compressed visual interpretation of the raw transaction data that the 19th century professionals spent their career dissecting. The principles of tape reading, understanding volume as the driving force behind price, and recognizing the cyclical nature of accumulation and distribution, remain absolutely critical in the modern context. While the physical ticker tape is long gone, its informational equivalents are central to institutional trading today. Modern traders access the same core data through tools like Level 2 data, which shows the depth of bids and offers, the time and sales window, which lists every executed transaction sequentially, and volume profile analysis, which maps volume distribution across price levels. The instructional takeaway for the contemporary trader is that the 19th century skill of systematic observation remains the essential key to understanding institutional activity. Technology has automated the processing, but it has not eliminated the necessity of interpretation. A trader who understands the principles of tape reading can look at a time and sales window or a volume profile chart and instantly recognize the signs of accumulation or distribution, just as their predecessors did when watching the physical tape scroll by. This skill provides the context necessary to differentiate between genuine market movement and automated noise. The enduring relevance lies in the fact that fundamental human and institutional motivations, greed, fear, and the need to accumulate large positions discreetly, have not changed since the 19th century. Large institutional players still need time and volume to enter and exit positions, and their actions still leave the same signature: high volume without immediate price progress during accumulation and distribution phases. Systematic observation, whether manual or digitally assisted, is the only way to detect these critical footprints of smart money. The conclusion is clear. The skill that separated the best 19th century traders was not a secret formula or an emotional prediction, but the ability to translate raw transactional data, price, volume, time, into a precise, non-emotional map of supply and demand dynamics. They were disciplined market statisticians who understood that the market's behavior was predictable only through the lens of objective data analysis. They were not gamblers. They were meticulous observers who waited patiently for the tape to confirm their analysis before committing capital. This foundational discipline, the rigorous and systematic observation of the market's internal mechanics, is the true legacy of the 19th century masters. It is the core reason why figures like Jesse Livermore were able to navigate the extreme volatility of the era and emerge as legends. Their success was built on the unshakable commitment to the evidence provided by the transactional record, a skill that transcends time and technology. If this deep dive into the historical origins of trading mastery resonates with your approach to the markets, we highly recommend exploring the new edition of Reminiscences of a Stock Operator. This classic work by Edwin Lefebvre captures the essence of Jesse Livermore's psychological and strategic journey, which was rooted deeply in the principles of systematic market observation and tape reading. Our new edition enhances this timeless narrative with unique commentary and detailed analysis for every chapter, transforming Livermore's raw experience into practical, actionable lessons tailored for the modern trader. It provides the psychological framework necessary to apply the discipline we discussed today, helping you manage the emotional detachment required to succeed. You can find the link to secure your copy and continue your education in market statistics in the description below. The greatest traders of that volatile age understood that the market was an auction, and the tape was the only accurate record of who was winning and losing that auction moment by moment. Their commitment to the statistical truth of the tape remains the ultimate lesson in market professionalism.